Is the 60/40 portfolio truly dead? Hey, everybody. I'm Serge Berger, your host of the Steady Wealth podcast. Great to be back. I've been having a whole bunch of discussions on the 60/40 portfolio, and don't worry, I will be defining what that actually is here in just a second in case you've never heard that before. But what really it comes down to when it comes to the 60/40 portfolio, again, I'll define it, is that a lot of people have heard that it's dead. It's over, it no longer works. And I'd like to give you a little bit of perspective on that because people are quick to draw those conclusions when in reality, I think a bit more perspective would be proper to be put to this. As always, I'm going to be showing a couple of charts, talking about a couple of charts. You will not be missing anything if you're listening on traditional podcast platforms here, but if you're watching this on YouTube, you will be seeing the charts and I will be describing them in great detail verbally as well. Let's talk a little bit about defining the 60/40 portfolio. And essentially, a 60/40 portfolio is an investment strategy that really consists of allocating about 60% of a portfolio of assets to stocks, equities, as it's referred to, and about 40% to fixed income securities, basically bonds. And usually it's a bit diversified within the bonds allocation. So it's not just like one type of bond or one maturity, but different kinds of maturities. So this allocation is essentially based on what we call a balanced approach to risk management and returns. There are advantages and there are disadvantages. And let me quickly walk you through those advantages and disadvantages, and then maybe demystify a little bit with some charts and the help of some stats and where we are, that maybe a 60/40 portfolio isn't actually dead. And I'll give you an alternative as well to a 60/40 portfolio, what I would consider to be a better version of that. Again, remember, none of this is financial advice. I'm talking to you through the lens of education and just my views. If you are interested in financial advice, we can help you out at that at the bluemarlinadvisor.com. That's www.bluemarlinadvisor.com. If you're interested in research and doing everything yourself without any advice, you can go to www.thesteadytrader, STEADY, thesteadytrader.com. Let's talk about advantages and disadvantages. First of all, advantages of the 60/40 portfolio. Again, the 60/40 portfolio is about 60% equities, 40% bonds. Advantages, the combination of stocks and bonds has over time provided diversification across asset classes. Now, typically, when one asset class performs poorly, the other may perform better and helps reduce the overall portfolio volatility. At least that is originally what it's intended to do. And quite frankly, over time, that hasn't worked badly if you look at it in the proper metrics. At least that's my view. Risk management. The allocation to fixed income has over time helped to mitigate risks since bonds are generally considered less volatile than stock. And we're not talking about high yield bonds here. We're talking about sort of the aggregate bond index. This can be particularly beneficial for investors with lower risk tolerances and kind of those that are getting closer to retirement. Let's talk about income, steady income. That's something that we talk about all the time. In fact, steady, right? The steady trader. I like that word a lot. Bonds typically have provided more regular income stream in the form of interest payments, their coupon payments. And this can be very attractive for investors that are looking for income or retirees relying on their investments for living expenses. And I'm going to come back to that part, the income part, which is also an embedded hedge to a portfolio. I'm going to come back to that here in just a few minutes because the 60/40 portfolio looks a heck of a lot different in terms of how attractive it is now than it did just 12 months ago. Historical performance, another advantage over the long term, and we're talking about 20-year look backs here when you talk about long term, 10 at least closer to 20. A 60/40 portfolio has historically delivered competitive returns with exhibiting less volatility compared to an all-stock portfolio. All-stock portfolios work very well until they really don't work for a couple of years, and then people really have nasty drawdowns. It doesn't happen that often, but when these drawdowns hit, they're really nasty. So the 60/40 portfolio has over time been able to mitigate that. And this makes it an attractive option for, I'm going to say, really all investors for the majority of an asset allocation, not the trading part where they want to go YOLO or the part where they buy real estate with, but like for the meat and potato allocation around that. Disadvantages. Like everything in life, there are advantages and disadvantages. Let's talk about the disadvantages. The allocation to bonds can sometimes limit the portfolio's potential for higher returns. The topic we talk about all the time, and that attitude is rooted in greed, which is dangerous. So to me, this lower potential returns disadvantage is not really disadvantage, but I'm trying to show you and play devil's advocate of how people tend to think. The people that tend to lose a lot of money in bear markets are the people that tend to think that a 60-40 portfolio inhibits returns. But let me just walk you through this. So essentially, the allocation to bonds can keep the potential return on a portfolio, especially if the stock market has a strong performance, like it has, for example, since coming out of the GFC, the Great Financial Crisis from 2010 on for the past 12 years, up until almost more or less recently. This can mean that a portfolio cannot grow as quickly, may not grow as quickly, and as an all-stock portfolio during bull markets. And this sector and group rotation part is also what I'm going to talk about in a minute. Inflation risk, obviously everything has risk, even fixed income has risk. Bonds may not keep pace with inflation over time, so inflation can erode the purchasing power of fixed income instruments, and thus potentially reducing the real return on a portfolio. So as inflation goes up, the price of bonds will go down. It's possible that doesn't keep pace with it. Interest rate risk is another risk. Bond prices and yields move inversely, which is what I just said. If interest rates rise significantly, the value of the bond portion of the portfolio may decline. In fact, it's actually exactly what happened last year in 2022. I'm going to get back to that in just a second. Market timing, another kind of disadvantage. Maintaining a 60-40 allocation steady through generally requires periodic rebalancing to keep the portfolios in check. These timing adjustments can be challenging, and the mistimed moves could impact returns. Now, again, notice this is a devil's advocate part. I don't think this really is disadvantages. This is just a disadvantage for people who are rooted in greed in terms of their attitude to investing. I don't think it's suitable for all goals, the 60-40 portfolio. This is not devil's advocate. I do think that is probably more factual. A 60-40 portfolio is generally considered a little bit more conservative. Again, that depends on where we are in the economic cycle. We'll get to that in a minute. It may not be suitable for investors with a higher risk tolerance. So if someone is extremely happy to take on risk, this may not be their thing. Or those with very long investment horizons. So typically, this is sort of investment advisor language. Typically, a 30-year-old, 25-year-old person that's entered the labor force just recently doesn't need to have 40% in bonds. They tend to say 20% in bonds is good enough. That's not my advice. That's what I'm just telling you. That's typically what's being said. Ultimately, the appropriateness of a 60-40 portfolio, though, to be fair, really depends on an individual investor's financial goals, risk tolerance, age, i.e. time horizon, and some investors may actually opt for variations of this strategy, such as 70-30, 50-50, to better align with specific needs and preferences. And it's essential to really carefully consider our own individual circumstances. So I think calling 60-40 dead is, quite frankly, a little bit too easy. So let's look at the first chart. Let me talk about a first chart. For that, let me quickly flip on over to the screen. Again, if you're watching this on YouTube, you'll see a chart. If you are listening to this through the traditional podcast avenues, you will be seeing the charts here momentarily. So the first point I want to make about the 60-40 thing is that, again, people have been saying it's dead. One reason people have been saying the 60-40 portfolio is dead since basically the Great Financial Crisis in 2009 is because bond yields essentially went to zero. And this is an important point. So even though bond yields went to zero, which means bond yields went down, bond prices went up, and the bond portion of a portfolio has done well in terms of directional moves because bond prices went up, what hasn't really been working is people haven't been able to receive yield. So imagine if you have a bond that matures, meaning gets paid back, let's say next month, and one has to buy a new bond. If interest rates are very low, one might only have gotten in the past 50 basis points, 1%, maybe 2% return, depending on what it is, which is very low, historically speaking, depending, of course, what kind of bond it is and so on and so forth. So I think that's why that's a big reason why investment advisors since about the great financial crisis. Again, that's when interest rates really started to plummet. If you're looking at the chart on your screen right now, and I'm describing it right now, and what we're looking at is essentially 2-year note yields, or treasury note yields. We can see that they basically plummeted, and by the time we got to 2011 or so, they were basically almost near zero, 10, 20 basis points. And during the great financial crisis, they actually bottomed at 80 basis points and then continued lower. And then basically during COVID, they were more or less at those lows again before screaming higher. And that's the point I want to get to. So when people talk about the 60-40 portfolio being dead, and people are regurgitating that, I had a couple of people on some talks I had last week bring this up. I thought the 60-40 portfolio is dead. And these are great. They're terrific and probably honest questions. And before we talk about why I don't think it's dead and why I think it's back, and I'm going to give you again a better, what I humbly believe to be a better version of a 60-40. Before we talk about that, let's talk about the constants. Meaning, sometimes people hear something and they think that is going to be true forever. Now, some things in life, of course, are true. Like, for the most part, I'm probably going to be paying taxes for the most of my life. I think that'll probably be true. I would argue that's probably true for many people. They'll be paying taxes. But some things change. I don't want to go into too many things that everyone can probably have their own examples. But just because one thing doesn't work one time doesn't mean it never works. Again, this is not applicable to everything here. We're talking about investing. So saying the 60-40 portfolio is dead and believing that is true for forever is essentially one saying that financial conditions, financial markets don't change, which of course is ludicrous. They change every day. So let's talk about a little bit why, again, more granularly, why the 60-40 portfolio was considered dead to some people for now about a decade plus. And again, it's because of interest rates. As I alluded to it before, we had interest rates go to basically zero, while bond prices appreciated in price, although they couldn't appreciate it much more because bond yields were already very low. When new bonds had to be bought at much lower yields, they just couldn't yield anything. So the income part, and I remember I said before I would come back to the income part, it's also a hedge. So for people that are listening to this, maybe they're retiring or have been retired for some time, or maybe they're retiring in 10 years from now, or even if anyone listening here is 40 years old, 50 years, it doesn't matter where you age is. And a need for income is something that I would argue, and this is not investment advice, but there's a serious need for income in portfolios. And so people that have been saying for the past decade that the 60-40 portfolios that are basically have been alluding to, if the people at least who recognize why that's being said, to the low interest rates. Look at the chart now, and I'm describing it, and we can see that interest rates over the past, let's call it 2 years now, have basically, I'm looking at 2-year yields, have basically gone from, again, 10, 20 basis points, that's 0.2%, to north of 5%, depending on which bond yield. Again, this is 2-year notes. Now, what that means is that if I'm buying a bond right now, or even something like an AGG ETF, which is the aggregate bond index ETF, I'm going to get a heck of a lot more yield, i.e. income, than I have for a long period of time. The last time the 2-year yields were where they are right now was in 2007, right? Even I, with my limited math and compared to some very smart math people I know, can do the math here, right? That's 16 years that we haven't been able to have yield like this. So if someone tells you for a decade that the 60-40 portfolio is dead, and that wasn't, I wouldn't disagree that it wasn't working well. I just think it's back. So we can really build great portfolios with yield, and whether that includes some government debt and includes maybe some really good high quality corporate debt, that's beyond today's discussion, but is something that ultimately does have to be considered. So 60-40 portfolio, in my view, not dead. We're being able to make a lot of money right now, relatively speaking, and absolutely speaking relative to where we've had bond yields over the past decade. So if you're now listening to this and you at all care about managing your money, or you believe you can manage your money, or you have been using your money, first of all, I would encourage anyone here to get an investment advisor. A lot of people have been scared away from that for the past decade because the indices have gone up every day and every year, but there hasn't been much need for that. They didn't think, but there's actually a lot of need for an investment advisor. It's a partner. I would encourage everyone to consider an investment advisor, a partner that you can talk to about the markets every week if you want to. Good investment advisors do that, right? So shameless plug, Blue Marlin Advisor. Blue Marlin Advisors. That's www.bluemarlinadvisor.com. That's what we do. We partner with our clients. We're there not just to make it an allocation, but we're there to talk about markets actively, tactically, and passively. Tactically. So anyway, long story short, the 60-40 portfolio, as much as I'm concerned, is not dead. I do think it's back because of these bond yields. Now, I promised you I would give you an idea of what I think something better is, or again, in my humble view. Now, to give you an idea, before we look at that, let's just consider a typical 60-40 portfolio. What I'm showing here, for those people that are watching this, I'm showing a very simple Schwab model portfolio. It has a roughly 60-40 allocation. It's a little bit touch skewed, but I'm going to quickly walk you through what some of these allocations are, and then I'll get to a point here that I think is really important. So a 60-40 model portfolio has, in this particular case, large cap stocks. It has bonds, of course. It has international stocks. It has some real estate investment trusts, which makes a lot of sense for diversification, but it has more bonds and different types of maturities. It has small cap stocks, it has emerging market stocks, and in this case, an international small cap allocation as well to equities. Now, if you listen to this, you may have noticed a couple of things that are missing. First of all, there was no talk of commodities. Commodities in a diversified portfolio, in my view, have a really important part of an allocation. Whether that's done through just an allocation through an ETF to the commodities as an asset class, or one wants to get more granular and maybe consider putting in some gold through an ETF or even physically. Again, that's all up to everyone else. So just by adding commodities to this mix, a 60-40 portfolio will, in our humble view, become much more diversified and just has another leg on the stool, right? If you consider a 60-40 portfolio having, let's say, two legs, and two legs typically aren't that stable depending on how big the foot size is, right? Consider that a third leg. Another potential leg to add to a 60-40 portfolio modification would be something like a special situation thing. There are ETFs, for example, and ways to add more diversification by maybe having tail risk protection, adding in an ETF that literally buys far out of the money puts in case the market crashes, or something such as special situations, a fund, for example, that takes advantage of stuff that's completely uncorrelated to the broader market, like a special situation. They're betting on a special situation taking place from a maybe geopolitical perspective, or more idiosyncratically speaking, on an individual company, buying that company, spinning off, whatever. Again, I'm just touching the surface of a couple of diversifications. All of this can be done by starting with a 60-40 base model and then going out from there. Now, around all of these perimeters, and I'm going to come back to this important part, I realize that a lot of people listening to our podcast, myself including, do like to trade in the market, to participate. But as I always like to say, and I truly believe this, I don't believe anyone should be trading with all their money. I believe most people, and again, it's not investment advice, but I believe most people should be having a diversified portfolio approach that is managed, however, in addition to having maybe a trading account. So what does that mean? That means an allocation to, again, a 60-40 or a 60-40 with modifications, like I mentioned, with commodities and other things. That is not a static allocation. That has to be changed over time. So as, for example, interest rates became very clear that we're going to start rising back in 2021, one of the things that we did for our clients, we dramatically reduced the allocation to bonds because bond yields went up, but bond prices went down. So that kind of stuff is what an investment advisor, at least I would argue one that actually is an investment advisor, not a product salesman, which most investment advisors unfortunately are. We at Blue Marlin Advisors do not fall into that category, just in full disclosure. But that's what a good investment advisor, I would argue, should do. And then on top of that, once we have a nice, again, modification of a 60-40 that's being tactically managed. That doesn't mean there's a trade every day, every week, but maybe once a quarter, once a month, an adjustment's made easily, right? That's easily doable in terms of it's not too much. Then on top of that, and I'm now going back to a quilt chart that I've been showing a few times. For those people that are not seeing the screen, what I'm showing here is just one of my favorite charts, and what it shows is how different asset classes have performed over the past 15, 14 years looking back. And what it shows is the randomness, the random walk of distributions over the years. So that means, for example, if large cap stocks did well in one year, they didn't do that well the next year. So for example, if we were to look at, I don't know, let's say small cap stocks, just to give you an idea, they did one year, then they did okay the next year, and then really badly the following year. Then they bounced back, and then they were okay. So again, this random distribution is where more tactical trading can come in and help. And whether you're looking to partner with an investment advisor who really walks you through these and feeds you these ideas with a phone call and talks about sizing and everything, which only an investment advisor can do because they are regulated like we are at Blue Marlin, or whether you want to try to do this yourself with a newsletter subscription, like for example, what we have at thesteadytrader.com, which is a publishing company, that is up to every individual investor on their own. Usually I like to really pitch an approach that is mixed, balanced, that has actually both. Because again, having someone to talk to, a partner, is very powerful, but you also need the research at the same time. So anyway, folks, that is my view on the 60-40 portfolio, where we are right now. I do hope this has been helpful and somewhat enlightening for those people that may have heard that the 60-40 portfolio is dead. Again, that's a static view. Of course, market change. And I think right now the 60-40 portfolio, particularly the modified version that I just talked about, is probably back in full swing. So that's as far as I'm concerned. Any questions, folks, please let us know. You can always email us at support@thesteadytrader.com. In the meantime, be well, and we'll see you in the next Steady Wealth podcast. Take care.